Good morning, traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, November 28th, and I'm Michael Boutros. Good to be with you guys this morning. Carlos, Iman, Kevin, Mark, Pete, Steve, Tom. Got the whole crew in the house today. Great to see you, Alan, as always. So, we are just getting some commentary. I do want to note that just crossed the wires from incoming Fed President Jerome Powell. Markets, I don't know. I've been talking to some guys here in the city, and they're interpreting it as a little bit more of a hawkish stance. Jerome Powell saying, and I quote here, "We expect interest rates to rise somewhat further and the size of our balance sheet to gradually shrink. Our aim is to sustain a long jobs market with inflation moving gradually up towards our target." Now, this is nothing new per se, but people are interpreting it as hawkish. Regardless, the dollar is still struggling here at near-term resistance right near 93. So we kind of popped a little bit through that. It's 2016 low day close, still holding below. We'll go over those levels in a moment. Upcoming event risk is on tap tomorrow, guys, with U.S. data. Also on Thursday, we do have the OPEC meeting, so we'll go over crude prices, which we've been following since Monday, or since the Sunday update, rather. On the list for today, DXY, Euro, Aussie, Dollar, Yen. From Monday's update, Kiwi dollar, dollar CAD, pound Aussie, which started moving lower today, and obviously the crude trade, which I just mentioned. We'll go over the levels on that front. Any other trade setups that you'd like to review, or any questions anytime throughout the session, as always, feel free to throw them on the message board at any point. All right, so let's jump right in. Here's what the DXY looked like earlier in the week, and here's what we look like now. The major focus as we opened, well, to take you back to the weekly chart, which you guys have all seen before, the reversal off that long-term trend line. We opened the week, or we closed last week below that 93.89 level, and again, that 200-week moving average. Still near-term resistance here as far as the weekly charts are concerned. Take a look at the daily, and same picture, right? We finally broke that trend line and leaves the risk lower in the dollar. Now, to start the week, we had noted that we were coming into near-term support, and that was 92.59, 618 retracement of the entire advance. You also had basic slope support for this formation that we've been in since the November trade calendar month opened, and certainly we were looking for a little bit of a support bounce here. Near-term resistance right back at 93. Bearish invalidation. The only thing that would put us really constructive on the trade would be a pop through 93.48. And again, on those monthly charts and the weekly charts, those all coincide right here. You also have the 100-day moving average in blue right at that region. So fast forward, here's where dollar index is trading right now. There's that support barrier, 92.59. We probed in it yesterday before rebounding higher. Here's near-term resistance at 93. Again, keeping in mind that our focus is always going to be on what price action says. So while everyone in the city thinks this is still more of a hawkish tilt, dollar index continues to hold near-term resistance. I don't want to put it past this thing, guys, to make a run into 93.48, but I am looking for signs of exhaustion. So on the way up, a momentum signature hold at 60 would be convincing, but largely speaking, the outlook still remains weighted to the downside here in the index. Again, here's what it looks like on a little bit closer front in 120-minute chart. Still holding within the confines of that median line formation pretty well. Hey, D, good morning to you. Great to see you in the room. Aussie, if you didn't say it, Tom, I got Aussie. Yep, it's on the list. No worries. But certainly interesting price action. Again, we have US GDP on tap, and that's going to be the second revision for the third quarter. Obviously, we're expecting a little uptick from 3% to 3.2%, so we'll be looking to see how that filters into price action. But certainly as it stands, looking for near-term exhaustion either here at 93 or 93.48. I did note last night, again, I want to take a quick note, guys, we are heading into the last couple of days of the month, so specifically, not so much today, but specifically like tomorrow and definitely on Thursday, you want to reduce your position sizes on any intraday positioning. These end-of-month flows can really wreak havoc sometimes on near-term price action. We don't want to get caught left-footed on that, so just keep that in mind as we get deeper into the week. Any questions here on the dollar index? Pretty clean cut and simple. That was a big support target that we started the week at. Not surprised to see this rebound. Looking to see a little bit more of a hold, a little bit more of an exhaustion trade for the upside here on the index. Questions? I think this is our fastest wrap up of the dollar index so far this week. All right, that's number one. Let's jump right into some more of the other setups that we've been following since the start of the week. Last night we highlighted the euro dollar, and I think Jamie gave you guys a warning on this last night as well. The reversal that we saw essentially into that key region of resistance. Note that we've been following 1947 to 1972. Bring up the euro chart here just to highlight that region. Is right over here. Okay, 1947 is the uncovered gap close that we did finally cover yesterday. Just higher. 1972 is a basic 786 retracement of the entire decline from the September high. So reversal candle off that region. Near-term price also saw a mean reversion right off that. And we're right back at support. And this is what we noted last night, 1886. The premise is on this focus right now. If we break below this, I am expecting a larger correction, down as low as 118. The intraday chart has a near-term confluence support right at 118.05, a basic 38.2 of the advance, and basic slope support off the lows. So that's the risk, let's call it, with a break below an 1885. You have a soft target at 1858. But really, the risk with a break here, there's so much lined up there, you'd look to see a larger decline towards 1805. That being said, you're opening U.S. trade at support. Okay? The focus for the upside targets, if we are to breach the overnight highs and make a run through that Asia high that we made, you'd still look for interruption here. Okay, 1947, 1975 is still going to be a region that you're going to want to watch to really see a momentum push through. Subsequent target, very clear, 2034 is the high day close for the year. And that was achieved back here on September 8th. So the levels are really clear. It's very similar. It's the exact picture, I should say, that we're looking at with the dollar index sitting right at resistance. Euro dollar sitting right at support. 60% of the index is weighted on the euro. So certainly we'll be watching this into the U.S. Open. Okay, ideally, we either get some sort of corrective action, the U.S. price action starts to look a little bit more supportive above this. That would be the rebound play. I'm still concerned that you could get the break. So I don't have any positioning on either of these right now. I really want to see how we perform around this level of support and around that level of resistance on the dollar index. But remember, we were talking about this yesterday in the webinar on daily effects. We were noting that, it's not necessarily the sexiest looking chart at this point, but despite the fact that you have all this play around the median line, you're still reacting pretty well to some critical support targets. So keep that in mind for the euro. Again, we do have some euro employment data and CPI data later this week, so we want to keep that on top in mind as well. But largely looking to see whether this pullback fizzles out here at 1885, or if we get the deeper cut, be looking for reentry at 1800. Look, I do want to note that depending on where we are in time, the time decay of this level is going to be really determined on when that breaks. So if we do get that break and it muddles down a little bit slower, you might want to pull the trigger or look for that long exposure ahead of 1800, depending on where we are in slope. But as it stands right now, levels are pretty clear. Okay, topside breach above not only the weekly opening range, but really 1975 is going to be what's needed to get this thing popping back towards that 2034 target. Any questions on euro? Pretty clean. No change to any of the levels that we noted last night. We basically came right here and settled into this near-term support. All right, so let's see if we can't get some play here in the euro heading into the U.S. session. Aussie dollar, another one that's been very interesting to start the week. I put this piece out also on Daily FX. Remember, we looked at this weekly chart. We've been talking about 76.30 forever. It's been a clear pivot in price. We broke below it. The risk is either, or the focus, I should say, for Aussie, or on the broader scale. Here's the weekly chart, just to give you guys a picture. Again, you've seen this before, but the focus is either for a drop into 74.76 for possible long exposure, or a breach above. I'm going to require 1750 to validate the reversal. Remember, there's a whole host of things that were lined up at 76.30, which is why we are so critical of any short exposure while we were above that. Now, once we cracked, kind of fizzled out ahead of that key support, again, a basic 50 of the entire advance from 2016, basic trendline support. that would be the last ditch effort, the larger bullish invalidation for the broader upslope. So long off that region, or if we do kind of fizzle out here and break higher, even if we rally towards 77.50, guys, use caution. That's kind of the yearly opening range break. And again, that would be a clear definitive move past the 52-week moving average, the 618 retracement, and that broader 38.2. Okay, so on the broader scale, the picture is super clear for Aussie. The momentum picture near term is kind of frustrating. Here's what it looks like on the daily charts. Okay, so again, you fizzled out right ahead of 75. And here's the reversal, right back, former key support. Remember, this is also the initial monthly opening range lows. So an inherent area, you'd start to look for resistance as is. Again, just higher into 76.70 or so. You have the monthly open, former trendline resistance off 2016 highs, former trendline support, and the median line for the current downtrend, all right here. Just higher, you have that 200-day moving average to contend with. So the upside targets are stacked. We just need to make a firm push back through the monthly open, in my opinion, to really get this thing going. Until that happens, the risk for a spill, one last spill lower, exists. Now, heading into tomorrow's GDP print, this could be the catalyst that we need. If we get a spill or if we get a really strong number and the dollar finds a little bit more of a firm footing, that might be the last catalyst driver that we need to get this dump into 75. That being said, here's what the intraday chart looks like for Euro. And here's what it looked like last night. Okay, so we came in 76.30, again, that critical area support, initial monthly opening range lows. There's the reversal after popping through. You did drift a little bit lower in overnight trade. We're pretty much, or we are virtually unchanged on the week. Okay, so what this tells me is it's coming into Tuesday. We're right under resistance. The weekly opening range is set. Level's pretty clear cut and simple. If we break the highs, look for that run towards 76.70. Also, aside from everything that we highlighted on the daily chart, it's also a basic 236 retracement of the decline from the highs that we made in September. So a good level of which, if we start to pop through, we would look to see if we clear that 77.40 level, 77.50 level, and again, that's a definitive level that would validate, a larger scale reversal here in Aussie. Any questions on that? Hey, Tom, does that make sense? I know you were looking at the Aussie. Any specific questions on this? Pretty limited as far as Aussie data is concerned for the month. You have some housing data and stuff, but I really wouldn't think that would be too much of a market mover on this. Okay. No, maybe just wait to see here. Yeah, I mean, you're unchanged on the week, so there's kind of, it's been just a really quick range right under resistance. I'm more inclined at this point to still look for a drop lower before I get on the long. Like I said, ideally we get the 75 pop. I don't know if you'll get that much dollar strength to pan out, but for me, look for a median line support bounce or break above 76.70, and that'll be the driver, I think, for Euro moving forward, or Aussie rather, moving forward. Okay, that is number 3, Aussie dollar. Number 4 from last night was dollar yen. So here's one that I have been involved in and out. Here's what the dollar yen looks like. I just wanted to highlight that we were turning, just pips away from that 118.82 target. Again, that was another gap in the dollar yen from back here, uncovered gap that we made back on September 17th, just pips away yesterday. And we also were marking, and I noted in the report that we were seeing some divergence into these lows, right? So the divergence into those key support levels leaves the immediate short bias at risk here. And that's exactly what happened. This thing fizzled out in overnight right as we came in, right after we rebounded off that, or ahead of that, I should say. And here we are drifting higher. The broader picture still remains bearish. It's the same trade as all the other dollar crosses we're looking at, guys. So we could see a little bit more upside here on a dollar recovery. But largely speaking, bearish invalidation is steady up at 1248. 1248 is just some former swing lows, some former swing highs, a decent pivot in price. also lines up and converges dead on with basic channel resistance. So as long as we hold preserve 1248 as resistance, I am looking lower. Immediate focus, I still think has the risk for a little bit of a pop higher to get a better entry. Now, ultimately, I do want to see a break lower, and 110.15 is a beautiful target. That's the 618 retracement of the entire advance from the lows we made in September. Also, basic slope support. This is just a simple parallel extended off resistance. We saw perfect touch here, converges down there on the 618 in the event of a bigger break lower. But guys, if you're looking at price action since the start of the week and you're getting a little frustrated because things are kind of ranging a little bit, that's, it happens. We have to wait for these ranges to clear out. Broader picture remains pretty clear. It's just, do you get the pop up towards 111.90 for a better entry in the short, or do you get the break below 118.82? I do also want to highlight 118.67. I put that as well. Former swing highs from the August trade month. So certainly, that late swing high has been a nice pivot in price as well. So give respect to that little zone of support. Broader picture still remains bearish up 1248. Near-term resistance still like 1198 or 1190, excuse me. The former swing low is right here from earlier this month, and also basic 38.2 retracement of the entire advance from September. So dollar yen, I'm losing a little steam here, but still on the lookout for a pop higher to get back on the short. And the reason, like I said yesterday, the reason I think you get that pop, and this could be the extent of it, I don't know. But the really strong divergence signals into the low, even if you're bringing this in, this is the 120, but even if you're bringing it into the closer time frames, it just looked a little vulnerable. I still think it does for a little bit of move higher. Now, notice that on the rallies since the start of the week, momentum has still continued to hold 60 as resistance. So it suggests that the broader momentum signature still is weighted to the downside. That doesn't mean we can't get a little higher from here, but certainly I think our broader outlook remains preserved here on dollar yen. Here's what it looks like on the daily, by the way. And the reason I think 1190 would be a sweet spot is because, that's even if you get into 1190, but here you have the 200-day moving average, the 100-day moving average, former swing lows, again from October. It's 1165, and again, there's 1190, that former swing low, and that 38.2. So push into this region, before a final push into the lower parallel, possible. But as long as you stay below 1128 or so, 1148 rather, or so, I still think you look lower here in dollar yen. Questions on the abomination? Again, keep taking a look just at the broader picture that we've been looking at for the dollar yen on the weekly charts. Okay, playing the range, simple, and it's all that we're doing. Note again on the upside here, just below 112. Okay, 52-week moving average, long-term 200-week moving average, right there again. Clarity in price, lackluster in momentum seems to be the theme of the day for most of these majors that we're looking at. That's number 4, dollar yen. Any questions on this before we move on? Okay, from Monday's update, and I think this is the one that I've been a little bit focused more so on since the start of the week, and that is Kiwi. The major play for Kiwi that we've been following has been this support bounce off of a major support level. Not only the yearly, it's the weekly chart for Kiwi, opening range lows, but it was also the 2016 open for that year. And obviously the low day close came in just a little bit higher, 68.45, so 54 rather. So 68.54 and 68.28 was kind of the focus region. We talked about this briefly yesterday in the webinar. The close here a couple weeks back looked pretty provocative. Last week's recovery and close back above did leave the risk for a bounce higher. Momentum did drift a little bit below 40, but you couldn't be surprised to see a bounce higher here on some of the divergence that we're seeing into these new lows. Keep in mind, 70 into 70.38, remains our bearish invalidation level. Basic 100% extension from the high. That's not really the focus, but more so you have the confluence of that, a basic 38.2 retracement, decent pivot in price, former swing highs, former swing lows. You also have former channel support. One touch, two touch, three touch confirms, break saw acceleration. That's there. Also, broadly speaking, on the larger pitchfork we've been following off the 2011 highs, the median line, the 50 line slices right through resistance, 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 acceleration on both sides. That converges on that same region. Okay, downside targets are pretty clear. If we get the break lower, the 618 is not too far off. I don't want to necessarily close out all short exposure if we do get the break there, but it is something I would look to operate on a little bit, maybe shave a little bit off, 67.22. But it really leaves the risk for a much larger drop on an objective break of the yearly opening range. Okay, remember the yearly opening range broke here, quickly recovered just 2 weeks or 3 weeks later, really invalidated that upside bias. Once we broke below here, our picture turned bearish. We opened, or last week, we came right into support. The open of this week, what we noted earlier on Sunday, was the fact that, again, the recovery had taken us back above that key zone of support and back above the monthly open. So that leaves the risk for a little bit of recovery. Again, strong daily divergence into the lows. Okay, price action making a much lower low on a closed basis. The oscillator making a higher low. One of the reference points sub 30 into oversold. One of the reference points above 30 typically will be a strong signal to the upside. Okay, there's a lot of different ways to dress this up. I was also looking at this. You guys know I'm not really too huge on using momentum triggers aggressively these days, but this was another one that was pretty clear. I was looking at this earlier today, not only because you got the divergence into that momentum break, but you even saw a break of the trigger. We came back, tested it as support, and rebounded higher. So it really gives a little bit more validation for the near-term shift that we're seeing in momentum. So Mike, what does that mean from here? Well, it still means that the possible for an upside rally, sorry about that, the possibility for an upside rally still exists. However, on the near-term front, we're testing near-term resistance. Here's what it looks like. So this is the chart that we have been following for some time here on the Kiwi, within the confines of this descending median line formation. Again, just off the July highs, the low that we made in August, and the subsequent high that we made in September. This is the 618 line, okay, of that range. So basic pitchfork, 618, saw resistance. We're testing it right now as resistance as well, 69. What do we have on the report? $69.36, and that's what we're testing right now. Okay, so remember, bearish invalidation at 70. The weekly charts highlight 70 into 70, what was it, 36, I think, was it? 70.43. That's the extreme. A weekly close above that would put this thing on a more constructive path. But even on the near-term charts, 70 highlights pretty nice resistance alongside that upper parallel as well. Okay, so long story short, I'm looking for an exhaustion either here. To be quite honest with you, it looks like it's probably going to pop still, but a short exposure off one of these two regions. Okay, if we do pop higher intraday, if you're nimble enough, sure, small position size on a long stretch back into 70, you do have a lot of room. It's a 70 pip rally. Be mindful of those highs that we made for the open of November. So this is your objective November opening range high at 69.77, but certainly bearish invalidation is still here at 70. So if we do break higher, look for an exhaustion entry at one of these two levels for a move lower. And last time I checked, there's literally like no Kiwi data on tap this week. Not of note, at least. Questions on the New Zealand dollar. Where we stand now, where we're heading now, looking for near-term exhaustion. Same picture that we're looking at basically with all the crosses, guys. Whoops. And remember, the emphasis is on the push below 68.30. Long-term support. and certainly would validate a break of the yearly opening range. That would leave us looking lower deep into the close of the year, guys, if we do finally clear this. A late opening range yearly break certainly does send, well, at least as I've seen over the years, will tend to keep drifting right into the close. So keep that in mind here. The emphasis on that 68.30 level is still pretty critical. Questions on Kiwi? Bear with me one sec, actually. I just want to see what this looks like. Okay. It's not the cleanest thing, but again, continues to highlight that 70 region. So I'll keep this off for the sake of clarity right now, but keep that in mind, guys. The near-term upslope, also, you might have just a basic upslope channel here. If you take a parallel off that, ooh-wee. Perfect resistance, perfect resistance, perfect resistance. Okay? Let's see if that high holds into the US Open. That is Kiwi. 1, 2, 3, 4. That was number 5 on the session. Questions on New Zealand dollar. Okay. So no change to any of the levels from that update on Sunday. We'll continue to see if that pop gets resistance here or gets that final stretch near 70. But near term, I would love to see a hold here into the US Open. Last but not least, from the updates, or actually we have a couple more, is dollar CAD. Kind of shorted, or what am I saying shorted? It kind of fooled me, or it got me sketched out. The focus here was to open the week. I talked about this briefly yesterday. It's an expanding range. I hate those types of trades. Not typically my best play. Look, the bearish invalidation level in my mind is still 21, a basic 618 of the entire decline from the highs that we made last month. Also basic slope resistance. Also former slope support. Okay, that's the level that would focus or shift the focus to the upside, would invalidate my near-term bearish bias. This is one where even if you look at the weekly charts, the range is really well defined of what you need to see. 129.27 on the upside break, or a break below. It's a little above 25, but I basically held it as 25. You have the 200 long-term week moving average. Then you have that 50% retracement. This is the focus range break for the weekly charts. If we breach higher, the risk for a 35 tap is not all that outside the realm of possibility. Okay, but as it stands right now, we have to clear this near-term range. Looking at dollar yen on the daily charts, okay, you have a clear monthly opening range set. Now, if the break below this channel support is legit, again, that channel should offer resistance, and that's kind of where we want to keep our focus lower while below. Fast forward or look at the 240-minute chart to start the week. Here's what it'll look like. We were opening up right here. Again, bearish invalidation at 28.21, near-term resistance 27.78. So we took out 27.78 on the recovery here in dollar CAD. Here's what it looks like now. And we're just pips away from the 618 retracement, that confluence region up at 28.20. We're currently trading right at the figure. But there's the advance into right here. So I do want to see a hold here in dollar CAD if we're going to move lower. Okay, basic. Former channel support should offer resistance. Former swing highs, 618 consideration. Basic channel resistance or basic slope resistance, all right here. All right here. So maybe another 20 pips higher or so, but I do want to start to see this thing fizzle, maybe even test a break of that before fizzling out. Long story short, if we clear this range on the upside, I'd start to get a little concerned they have a larger recovery at hand here. Also, if we do break this high, the target that we had noted is down here, 125.80, let's just call it 125.86 and 125.90. You have the 100% extension, so if this is corrective, 2 equal legs down would take you right into that zone. It's also a basic 38.2 from the entire advance off the September lows. Also basic former swing highs. Pivot break saw acceleration. That's down here. If we break this high, what I wanted to note is that this extension, the 100%, becomes null and void, right? Because when you're looking for the extension, the reference points need to be preserved for that target to remain valid. Once we break that high, if we do, that'll take away the 100% extension, so just keep that in mind. Other than that, levels are pretty clean here on dollar yen, or dollar CAD. Here's the 120 looks like. And I was looking at the 60, looking for signs of exhaustion to the U.S. trade session. When I came in this morning, it was already into overbought territory still. So you don't want to fight this kind of trade. You want to see recovery back below 70. You want to see an exhaustion spout into 128.20. I think that'll be a near-term nice move. Questions on the loonie. Now, I'm going to segue into crude after this. We're going to jump over at pound Oz and we'll come back. But I do want to note, you do have really significant crude event risk on tap. Thursday, we're going to have that OPEC meeting, and the real sort of the chatter that the market's really focused on is if this production cut is going to get further extended. The deadline was set to March. If they do extend that, there are talks of even extending it past into next year. The competition that everyone's kind of been going under the table, and most people haven't been noticing, is what's been going on in the shale markets, right? As crude prices have increased, shale production has sort of ramped up as well. And while OPEC is sitting here talking about what's going on with crude prices, if they do continue to, call for this production cut, quote unquote, that could continue to fuel prices higher. For the dollar CAD, might be what we need to get this bounce on some CAD strength back to the downside for the pair. So we'll take a look at crude prices in a moment. Any other questions on this near term? I do want to highlight, I was looking, even though that we are seeing this divergence right here, it doesn't look like divergence anymore. All right, well, you got divergence on the hourly chart. So again, bringing this into a line chart, been looking for signs of exhaustion ever since I came in. Here's, a higher high in price. Here's a lower high in the oscillator. Again, both reference points above 70, so a very weak signal. But we'll see if we can't materialize on a final stretch higher. Specifically, if we're not able to make a new high in the oscillator, that might be the signal in early U.S. trade for the loonie. Questions going once, going twice. Let's take a look at crude prices. That'll be number 7 here on the session. Here's what crude looked like earlier in the week, and here's what we look like now. The focus here, again, I started out larger because I think the pictures of these major trades where we're coming into some real critical levels really represented better on these weekly charts. So you can see, again, we've been talking about 60, 59.94 is a critical area of resistance. You had a 618 extension, a broader 38.2 retracement, long-term 200-week moving average. A whole bunch of stuff was lined up there. And certainly the advance looks like it's at risk for a pullback off that level. The broader picture still is constructive, even if you get a move past 54, in my humble opinion. This thing is pretty bullish. Remember, we broke a late break, and we were just talking about this earlier in the session, a late break of the yearly opening range certainly has this thing on a topside trajectory heading deeper into the close of the year. Daily charts also, there's the yearly open, there's the break, come back, check it as support. This pop was a break of the monthly opening range, again giving us a topside bias heading into the end. To start the week though, we were right at resistance, plain and simple. 1618 extension off the lows, tagged 59.12. Again, we also had the median line for the current operative formation that we've been following off the highs. Both those converged right here. Momentum, also a little tired, right? Very weak divergence because both signals are above 70, but it's there nonetheless. We don't want to ignore it. So even on the daily charts, showing the risk for some near-term exhaustion. Fast forward into the intraday charts, well, we opened right at resistance. So recall, we were talking about exhaustion either here, 59.12, or that stretch into 60, that key region that we were talking about on the weekly chart. Both areas looking for some possible pullback. Near-term support 57.96, or near-term support target, followed by the median line. And again, the time decay of that, you're always going to want to keep in mind. So sort of the monthly open near 56.87 was what I had highlighted here, but you want to give credence to that median line. So long story short, here's what it looks like now on the crude trade. Crude, there you are. And we got the pullback. 57.97 has been tagged already. And again, this is why I'm looking for possible signs of near-term exhaustion here. I wanted to see a clip of the lower parallel. I don't know if you get it. Note that we've been getting ongoing momentum divergence into the decline. This is a 60-minute chart. And again, if we make it back above 57.96, could be continuation. I wanted to see a couple more down days than just one, to be quite frank with you guys. So I'm not going to take a stance on this here. While I do want to be long, I just don't have anywhere to really put a respectable stop. If we break 57.96, a stop against this low could be in play for the continuation. But as it stands right now, I kind of still think you have a little bit more downside to go on this. Remember that OPEC meeting is just 2 days away. It's likely to charge a lot of volatility in the energy markets. See a quick extension here, what this looks like. Bear with me one sec. All right, so look at that. 100% extension actually takes you right down to that same level that we've been highlighting, so 56.87, 56.86. I bet you a 618 will be right where we bottom today, and it is. All right, so let's keep your focus on this near-term range here heading to the U.S. trade session. On a dump lower, like I said, that's kind of like a sweet spot I was looking for, but any position you take on this today, specifically today and tomorrow heading into Thursday. Remember, Thursday is not only the OPEC meeting, which we've been waiting for all month long, but it's also the last day of the month. So a treacherous time. But certainly broader picture still remains constructive here on the crude trade. The question is, how deep does the correction get? Questions on crude? Okay, that is number 7. Again, feel free. I do see a couple new names here today, guys, so welcome aboard. But as always, just want to remind you, there's a camera button at the top of your GoToWebinar screen. If you ever want to take a picture of any of the screen or any of the charts that we have presented, feel free to do that for reference later in the day. As far as the crude trade is concerned, no changes to any of the levels that we highlighted earlier in the week. The only thing I added was that near-term extension. Okay, highlights 57.42 and further highlights the 56.87 target that we've been watching. Okay. Last but not least from the updates, I do see your question there on the pound. I will get to the pound. I just want to go over pound Aussie first. That was one that we highlighted on Sunday. Here's what pound Aussie looks like. My favorite play on this one was for, in the event of pound weakness. So you guys all know that we've been pretty constructive on the sterling. I don't want to take. Let me take a step back. In the event. Let me take another step back. When the markets rally straight up, right? I don't necessarily want to take a short on pound dollar because I'm not sure I really want to participate too long on an aggressive long dollar exposure. But for a pound pullback, I think Aussie was a great play just because of where we were playing or where we were trading on Aussie. And I think on this one, the critical nature of the barrier that we came into was huge. And again, don't take my word for it. Here's what the charts say. You have a long-term median line extending off the 2016 lows, encompassing all of this year's price action. That exact median line is right here. You have a basic 38.2 retracement from the decline off the highs of last May. Okay, that comes in at 176. You also have the yearly high day close. Okay, the high was registered on May 10th. The close for that session came in at 75.61. Key region of resistance for the advance. So certainly you've been seeing that hold as resistance all month long. Momentum is also pretty lackluster, I want to say here. This is not by any means a bearish momentum profile, but it certainly screams exhaustion, right? Ever since the highs that we made back here, price action has made another high. The oscillators continue to hold those highs ever since. So, I guess this is the one that would be a little bit more pertinent for what's going on right now. Okay, and it puts momentum basically right at support. So if we break this near-term range to the downside, not expecting a major collapse or anything, but 73.46 would be an initial target. Daily bullish invalidation. The only thing that would shift the entire focus back to the downside, in my humble opinion, would be a 70.86 break. Now, keep in mind that this is a basic trendline breach dating back to 2015, guys, which is why we've been constructive on this trade for the last couple of months. Again, the question here now is just the simple correction, how deep it gets as far as the pull lower. So no change to the daily chart. Again, I think I provided the daily chart here, right? Oh, yes, I did. And also the weekly chart. I want to actually, here's the daily chart. So no levels, no change to any of these levels. But the weekly chart also was very compelling here as well to suggest that if we are looking for a pound pullback, if we want to offset some of the exposure that we have on the long pound side, this is a decent play. Again, that basic median line, and just looking at it from a structural standpoint, you want to stay constructive above 71.91. Excuse me, 71.19, and that's this region right here. Weekly chart suggests the same exact thing. Here's what the weekly looks like now, by the way. Boom. Right? Pretty clean. Pretty clean. So how deep can it go? I want to see this thing push. Here's what the intraday charts look like again. Okay, near term 73.46 would be a nice target that I'm looking for. You know, I might look to take a little off here, just at last week's low, bring stops to break even and see if we can't get the push, but that would be a really sweet spot. That's kind of the high close that we made back here in October. And it's not too far off the monthly open, 73.46. Ah, I'm sorry, it is the monthly open. Sweet. So monthly open, 50 line for the current operative slope to the upside as an initial target for the move lower here in pound Aussie. Larger ATR pair, guys, so keep in mind, you know, if you're going to get involved in this one, you want to make sure you reduce your position size. Obviously, the leverage hold on this is larger as it's a sterling position. Looks pretty good still. As far as the pound is concerned, that'll be number 9. Here's what sterling looks like. Here we go. So with pound, we are getting the pullback. Just to bring you back to the broader weekly charts and why we remain broadly constructive on this trade, very, very simple and very, very clean. You're still trading within the confines of this median line formation. Momentum still holding that basic slope support, and again, as long as you stay above the upper parallel, I do want to stay constructive. Now, last week we were talking about 130.36 being our bearish invalidation level, or bullish invalidation level, excuse me. I'm still inclined to work with that same region, although slope obviously now on the time decay comes much higher, basically at the 131 handle or so. But you know, the initial focus here, the risk is for just a pullback lower. I don't want to work with a full-on reversal here. Here's what it looks like on the daily charts. Again, we just simply failed here at the October range highs, not the actual range high for the month, but that swing high that we registered back on the 12th. On a closed basis, continue to hold its pretty rock solid resistance here. The pullback, guys, is now testing the monthly open. Okay, the monthly open comes in right here at 132.83. We're right there right now. Just lower, you have that 1618 extension, which was the exact high that we registered back here in August. That's 132.72. So I want to see this thing get a little bit lower for re-entry back on the long side. I don't really have clear-cut targets, to be quite frank with you guys, of where I'd want to do that. I do know I want to stay constructive near term above 131.41 now. Again, that lower parallel converges on the 100-day moving average. And that's going to kind of serve as my near-term bullish invalidation level. But it's been tough here to get excited on the long side again. You know, look like a very well-defined or pretty readily identifiable exhaustion trade, specifically on that really mean reversion candle. That candle that we made there at 9 o'clock yesterday at the open was pretty definitive. And we broke right back below the weekly open, so it certainly does leave this thing a little bit more vulnerable for a near-term bounce lower, or near-term decline lower, rather, towards slope support. So don't have anything on this, but I want to see if I can get back on the long side on a decent pullback. Any questions on the British pound? Yeah, I've been looking for some structure to the upside beside the broader slope. I just haven't been able to find anything. Um, I was working with this yesterday, just kind of checking it out. Excuse me. Let's see what kind of play we would get on it. That didn't work. Even if you bring it into just a basic original slope, the upper parallel didn't quite catch resistance, but here's the lower parallel right at the November open. So it was highlighting the same level already, so which is why I didn't want to kind of clutter the chart with this. But um, if this holds, still puts the emphasis on a break above 33.38 to get maybe continuation on the upside. Not the most convincing trade. I know what my bias is on the broader scale, guys, but on the close near-term time front for pound, it's kind of stuck where euro is, kind of stuck where the yen is, where you're kind of really lackluster weekly opening price range. The levels are still crystal clear. It's just the momentum has been lackluster. I want to see this thing hold near term for us to continue to favor this immediate advance. But again, downside break, I think you do risk a correction back towards that lower parallel. All right, questions on sterling. Yeah, we're clear on sterling data too. Consumer confidence is slated for Thursday, but nothing really crazy. Okay. That's everything I had on the list for today, guys. Let me know if you have any questions or last-minute setups that you want to review. Again, major highlights or things I'm really focused on over the next 24 hours. Obviously, these dollar crosses, they're at key ranges at this point. Crude trade, we've been following that closely. I do want to see this thing start to show signs of support on a move a little bit lower. I think this is going to be a very popular trade, specifically this week with that OPEC meeting on tap. We talked briefly about gold. Here's what the gold trade looks like. I'm not really a big fan of what near-term price is saying here on gold because I just don't think there's actual clarity on trying to take a near-term position. But we've been talking about 1309, 1308 forever, and I think that's still the region I want to see on the upside breach to mark continuation. This is not something that's very convincing to me. Okay, there wasn't a clear monthly opening range, break in gold. Momentum has still been unable to clear 60 on the upside ever since the October low that we made. So, on whole, to look at this thing over the last 3 months, it is still trading in a range. Momentum also trading in a well-defined range between 40 and 60 as well. I think you need a little bit more clear, definitive break of this to get aggressive. Bullish invalidation at this point. We raised it from 1246 and 1263, and I like it higher. I just can't get long here. There's no respectable place to put a stop on this. So you either need a bigger correction or a push through 1309 on a closed basis to really even give us hope for getting back on the long side for gold. But as it stands right now, not really anything I'm looking at for immediate positioning. All right, that's number 10. All right, guys, so if there are no other questions, we'll go ahead and wrap it up here. We'll be back on board tomorrow morning, as usual, with another intraday strategy webinar. I'll give you guys an update tonight. Keep in mind, again, reduce your position sizes, guys. Look for some of this stuff to start getting a little bit weird heading into close of tomorrow's trade specifically. We'll go over it again, but keep in mind you have some U.S. data today. Mostly the big hitters will be tomorrow. And then Friday, you got a whole host of data, and specifically for the dollar CAD that we've been talking about on Friday, you get the GDP release for CAD, you get the employment data for CAD. Should be a nice day for loonie price action, specifically as we trade near resistance here. All right, guys, I'll wrap it up there. Best of luck trading. I'll see you all tomorrow morning. Cheers.